it's like throwing cold water on everybody because we're all taking significant losses. But we have to keep in mind that markets right now are not really being driven at all by their fundamentals. It's really by stale news. It's by sentiment. And it all started last Monday here in the U.S. And it continues. We're seeing these wild gyrations in just about every asset class, especially the equity market and oil. And we have to come back and say it's not following, or at least it's not in line with global growth. Fully admitting that there are changes at the margin, but the fundamental landscape has not changed that much to warrant that much moves in the market.
Larry, I guess all the headlines pointing to China's growth slowing, but this is nothing new. I mean, we have known that China's been slowing for many years now. So what are some of the sort of important changes influencing the Chinese economy that we should be more concerned about?
You know, I think what we need to be concerned about is actually, the price of RMB. The market has basically priced in that they're going to continue to devalue their currency. They're going to need to. They have a lot of ammunition. They have a lot of financial tools at their disposal. They have a lot of reserves. I don't buy the argument that they're in bad shape at all. I mean, I think it's going to be a soft landing. It's going to be very well engineered. Today's excuse was the PMI number, and you have to realize that PMI is very objective. It's a survey handed out to participants, and you just cannot, you can't take the objectivity out of it. Also, it's a lagging indicator. So, I'm looking more at the monetary policy and just hoping that they continue to telegraph that around the globe.
I guess that slowdown in China also adding to pressure on oil prices, and really the big story over these recent sessions has been those massive swings in crude oil prices, sparked by the EIA's production report. Also chatter, I suppose, around OPEC. Do you think that the fundamentals are all pointing to higher oil prices from here?
I think if you look at the fundamentals, if anybody bothers to read them, that we will see higher oil prices, but probably not till the middle of next year, 2016. When you look at the supply, it's very good. You have OPEC still producing about 2 million barrels a day over the quota. We've had continued and persistent upside surprises from Russia, Iraq, Saudi Arabia, etc. U.S. production has curtailed a bit. However, they will not balance the market. On the demand side, demand in the first half of 2015 has been very, very strong. 1.5 million barrels a day. Anything near 1.2 million barrels a day will keep us from being balanced until the middle of next year. And lastly, I just need to say that people aren't talking about the fact that China continues to import at a double-digit increase when it comes to oil. So it's just going to take a while to get it out of the system.
If we take a look at the market, and you mentioned those fundamentals not changing, if we observe the S&P 500 towards the back end of August, it does seem clear that the fundamental landscape is going through a phase of adjustment. How dramatic is that adjustment, though? I mean, are the fundamentals much stronger than many actually appreciate?
Yeah, I don't want to be that flippant. I mean, there definitely have been some changes around the margin of the fundamental landscape, but it's just not big enough to warrant the kind of moves we've had. On top of that, I have to say that for weeks and weeks, I would talk about how the S&P 500 is not moving. It's not moving. I think it's for 7 months. It was in a very small range. And we just know from history that any asset class that sits there, the longer it sits there in a tight range, the bigger the breakout or the breakdown is going to be. And I think this is a classic example. All of a sudden, people are talking about valuations of the stock market and earnings estimates going forward. I mean, it is true. We have a little bit of slowdown in growth, but I think we're in the middle of a U-shaped recovery, especially in Asia. It's going to take a while. It's not going to be easy, but I don't think what I see behind me does not warrant the news that I'm reading or looking at.
Larry, we talk about China, but of course the Fed also very much drawing the attention on markets at the moment. We saw Stanley Fischer saying on Friday that the Fed will raise rates despite low inflation. So I guess a lot of it now comes down to the labour market, and of course Friday's non-farm payrolls are going to be really crucial for the Fed's thinking on those interest rate moves. I mean, how bad does that jobs number have to be for September not to be the lift-off meeting?
I think it's got to be an outlying number. It's got to be somewhere like below 150 or above 350 to change anybody's mind, to be quite honest with you. It's hard to imagine. I know meaning me as well. I mean, I just tend to focus on that one number. But the series of numbers going back have just suggested that the U.S. labor market is definitely strong enough. Our economic data is definitely strong enough to withstand a quarter-point Fed rate hike. I think where the disconnect comes is that even if there is a rate hike, the Fed's probably going to lower their dots forecast. I mean, their 3-year, 4-year dots forecast of like 3.5%. I just don't see that happening. So it's going to be a mix of dovishness and hawkishness at the same time.